Welcome to this explainer. Today, we are decoding capital markets, and we're going to do it using a massive, high-stakes scenario. If you've ever wondered exactly how companies fund these billion-dollar expansions, and more importantly, where your own wallet fits into that whole picture, you are in the exact right place. We're going to take some pretty complex financial instruments and break them down into clear, actionable knowledge. So, let's get started. Okay, let's dive into this. Imagine a company called ABC Corporation. They are growing incredibly fast, and they desperately need to expand their manufacturing facility. The catch? They need 5 billion pesos to make it happen. I mean, that is a massive influx of cash. You definitely can't just swipe a corporate credit card for that kind of money. They have to go to the capital markets to raise long-term funds. But how exactly do they convince everyday investors or big institutions to just hand over 5 billion pesos? What do they have to give up in return?
Here is our roadmap for this explainer. First, we'll look at the 5 billion peso problem itself. Then, we'll explore the big three financial instruments: stocks, bonds, and preferred shares. Finally, we'll put them all head-to-head and see exactly how this plays out in the real-world Philippine market.
All right, Section 1, the 5 billion peso problem, and figuring out what a financial instrument actually is. So to raise this 5 billion pesos, ABC Corporation has to offer something valuable in exchange, right? They issue what's called a financial instrument. At its core, it's really just a formal contract. When ABC Corporation asks for your money, they hand you this security in return. For you, the investor, it instantly becomes a financial asset. But for ABC Corporation, it becomes either a financial liability, meaning they literally owe you money, or an equity instrument, meaning they've just given away a piece of their actual company. It is very much a two-way street. So let's look at the very first path ABC Corp can take.
Section 2, stocks. The ownership path, which is option 1 for ABC Corp.
Now, what's really interesting about this is that if ABC Corp chooses the common stock path, they are raising permanent capital without the heavy burden of fixed, mandatory interest payments. But they are selling actual pieces of their business. If you buy in, you are a part owner. You get to share in all the upside, potentially earn dividends if the company happens to distribute profits, and you even get voting rights on major corporate matters, like picking the board of directors. But for the original founders of ABC Corp, well, it means giving up a piece of their kingdom and diluting their own control.
But let's flip it back to your perspective as the investor. This ownership path absolutely carries the highest risk. Why? Because returns are never guaranteed. Stock prices fluctuate wildly based on everything from the company's performance to the broader economy or even just investor mood. And crucially, as an owner, you hold the ultimate risk. If ABC Corp fails and goes bankrupt, common shareholders are literally the very last people in line to get paid. You get what's called a residual claim. That's just a fancy finance term for getting whatever pennies are left sitting at the bottom of the barrel, which honestly is often nothing at all.
Section 3, bonds. The lending route, which is option 2 for ABC Corp.
So what if the founders don't want to dilute their control by issuing stocks? Well, they look at bonds. Think of the stark contrast this way. Stocks mean you own a piece of the pie, while bonds mean you are just lending the bakery money. The founders get to keep full control of their company, but in exchange, they take on a very strict, legally binding debt obligation. When you buy a bond, you are establishing a debt relationship. ABC Corp is promising to pay you a fixed, highly predictable return, usually called the coupon, at regular intervals. Then, on a specific maturity date down the road, they promise to hand back your entire original investment. No, you don't get a vote in how the company is run, but you do get priority. Because you're a creditor, ABC Corp legally has to pay you before they are allowed to distribute a single cent of profits to their shareholders. That said, bonds are not completely risk-free. You still face credit risk, like what if ABC Corp goes under and just fails to pay you? You also face interest rate risk because bond prices naturally fall when broader market interest rates go up. Plus, there's inflation risk. A surprising and honestly frustrating reality for a lot of investors is that a safe, fixed return can actually lose you money and real purchasing power if inflation spikes over time.
Moving on to Section 4, preferred shares. The hybrid route, and option 3 for ABC Corp.
Now, what if ABC Corp wants the best of both worlds? They want to raise equity capital, but they really want to avoid heavily diluting their voting control. Preferred shares are the answer. And this brilliantly illustrates how you can blend the traits of both stocks and bonds into a financial hybrid. Think of preferred shares like having VIP status at a club. You get priority. You get paid your fixed dividends way before common shareholders see anything, and you're ahead of them in line during a bankruptcy. The catch? You usually have to leave your voting rights at the door. Section 5, the ultimate showdown. Let's look at risk, return, and priority. All right, let's bring all three of these options together. So the crucial point is how you actually match an instrument to your own specific financial goals. Growth-oriented investors, who are totally fine accepting high risk for the highest potential upside, are gonna aim for common stocks. Income-oriented investors, who just want safety and a predictable return, are gonna look at bonds. And for that moderate middle ground, predictable income without being a pure creditor, you've got preferred shares. Ultimately, all capital markets are built on one basic, undeniable principle: higher risks require higher potential returns.
To really hammer home that risk, let's play out the absolute worst-case scenario. Let's say ABC Corporation's huge factory expansion completely fails. The company goes bankrupt, and everything is liquidated. This countdown shows exactly who gets paid out first from whatever little cash is left. Coming in at number 1, secured creditors. Number 2, unsecured creditors and our bondholders. Number 3, preferred shareholders. And finally, sitting all the way at the bottom of the barrel at number 4, common shareholders. This is the exact legal hierarchy of who bears the absolute most risk.
Let's move to and see how this builds into our final section, Section 6, the Philippine market context, and where to actually trade.
We've talked a lot of theories so far, but let's bring these abstract concepts back down to earth. If you want to put this into practice locally, here is where these exact instruments actually live. Shares are traded right on the Philippine Stock Exchange, or the PSE, usually through licensed stockbrokers. Corporate and treasury bonds run through fixed income platforms, like PDX. But here's the best part. You do not need billions of pesos to get started. Retail treasury bonds and pooled mutual funds make these massive capital markets totally accessible to everyday investors. The tools to build your wealth are literally right there waiting for you.
Which brings us to our final and honestly most important question. When a company like ABC Corporation comes asking the market for 5 billion pesos, how are you going to respond? Are you an owner seeking high growth, a lender demanding protection, or maybe something right in between? You see, understanding these instruments isn't just about knowing finance for the sake of it. It is the absolute key to unlocking your own wealth. So when the next big opportunity hits the market, will you know exactly how to play the game?